Hello everyone, Charles here, and in this presentation I'm going to cover understanding slippage, what it is and how to avoid it in the forex market. As always, we must start with a disclaimer. Feel free to pause the video and read through the entire disclaimer, but when trading any financial asset, there's a possibility you may sustain a partial or total loss of your investment funds. As a result, it is advised you should never invest with or trade upon money which you cannot afford to lose through this manner of trading. Trading involves a real risk of loss, and past performance does not ensure future results. So let's get started. What is slippage? When you place an order and the price is not executed at which the trader requested. This price difference can be positive or negative depending on the direction of the price movement, long or short, and whether you are opening or closing a position. If slippage were to affect your positions, some brokers would still fill your orders at that worst price. When does it occur? Usually traders experience slippage when the market is experiencing higher volatility, creating susceptibility to unexpected trend movement. How does it occur? Slippage usually occurs when there is a low market liquidity or high volatility. When the markets are experiencing low liquidity, there are less market participants taking an opposing trade. This leads to more time being required from order placement to execution. This delay can change an asset's price from when the trader initially entered the market order. When it comes to forex trading, slippage most often occurs when volatility is high and liquidity is low. Forex traders usually experience a higher rate of slippage on less popular traded assets. The assets that are traded most usually have higher liquidity and lower volatility. So how can traders avoid slippage? Choose a reputable broker. Network settings, terminal settings, stick with higher time frames, trade markets with low volatility and high liquidity, and execute limit orders over market orders. So let's get into a little more detail. Choosing a reputable broker. Regulated brokers usually have a higher reputation and are monitored by the CFTC. Check reviews of any brokers you are considering and make an educated decision before going all in. Think of it like this. Do you just go with the first insurance or mortgage company that comes along? I would hope not. Take the time to make the right choice. Even contact the broker that you're considering. Ask questions that will impact your decision and see what their regulations are on slippage. Network settings. Make sure you have a solid connection to the network or use a reliable VPS. Use a wired connection over a wireless connection or Wi-Fi. And turn off any program that requires internet. This could be Dropbox. This could be internet browser, obviously, Skype, Telegram, Twitter, any kind of push notifications, calendar, different things like that. Turn all of those things off so that when you're actively trading, all of your network resources, are being used to actively trade. This is very important, and a lot of people don't consider it. Don't take it into consideration. When you're on a lower time frame trading, this will more than likely impact you. Terminal settings. Open new orders with settings of maximum deviation from the requested price. Set the maximum value of slippage. Sorry about that. That was a bus going by. Set that maximum value of slippage. And if price goes beyond the identified limits, the order will not be executed. Stick with higher time frames. Why treat trading like gambling? I personally prefer the D1 time frame. Although I do take a few shorter term trades, 90% or more of my accounts are long term. Choose to push yourself toward higher time frames and create less stress for yourself, along with a much lower chance of slippage. News trading will still more than likely push a trader toward lower time frames, so keep this in mind. Follow the rest of the suggestions I've given for avoiding slippage, and you should be solid overall. You can also choose to only trade news strategies that enter after the news release has occurred. Trade markets with low volatility and high liquidity. Limit your exposure to slippage. Low volatility means that the price is less inclined to change quickly, and high liquidity means that there are a lot of active market participants to accommodate the other side of your trades. Hours that experience higher activity may also experience a higher liquidity. Choose popular assets over less popular ones. They usually have a higher liquidity and lower volatility. Execute limit orders over market orders. Limit orders enter the market at a more favorable price than those of market execution orders. What you are willing to enter at is what it fills at. So you define the terms. It's like you become a market maker in a sense, okay? And set your pending orders. Let them ride. If they fill, they fill. If they don't, they don't. Move on to the next trade if they don't. That's it. If you're interested in more free trading education, accessing great strategies, or joining our academy, please go to slicktrade.net and we will see you there. Thank you.